Okay, good to go. All right. All right. Hey, everyone. So this is a pre-recorded lecture from the UF Financial Wellness Department about when we talking about loan awareness today. So, this is just going to be pretty informal. If you have any questions, we'll get to that, of course. But if you have any questions, feel free to schedule an appointment with us since we can't answer them, right now, obviously. So our mission is to financially empower students with the knowledge needed to make sound financial decisions during and after college. And at the Financial Wellness Department, we're focused on the big five areas of holistic financial wellness, and that's earning, spending, borrowing, protecting, and saving and investing. And they all go hand in hand away, right? So earning, I think one of the biggest things, that we like to talk about is budgeting. If you meet with one of us, we're definitely going to mention a budget at some time. It's just it's what we do, right? And that works with spending, and then borrowing is kind of what we're focusing on today. And but we can also talk about basic investing and how to protect yourself from fraud and spending money online. So we've reached students through on-demand financial education workshops like you are currently sitting in. We also do one-on-one peer financial coaching, and again, you can sign up at our website, which is just UO Financial Wellness. I'll get the link at the very end of it. And we also work across campus, building partnerships with other departments and programs. Okay, so let's just jump right into defining the different kinds of loans, right? Because I'm going to be using a bunch of loan terminology throughout this workshop, and we just need to kind of square it away. Okay, so we have government, private, and small bank loans, and then at the bottom you see large bank loan pros and cons in line with the private loan section. So government loans are what kind of like traditional student loans, right? So you're going to be seeing these when you fill out the FAFSA and you get money from the government. That's a government loan, right? And they generally have low interest rates, no fees. They can have loan forgiveness depending on the situation. They have loan deferment, which is a really important thing. Economic hardship safeguards, which is, I think, one of the most one of the biggest factors that sets government loans aside. We have economic safeguards. Hardship safeguards are, for example, when there's an economic crisis, like in 2008, there was a substantial forgiveness and allowment of slower pay rates and lowered interest rates when the global economy, or when the U.S. economy was going through a hard period. So private loans generally have fees. There's no loan forgiveness almost ever on that. High interest rates by comparison, although you can find some that aren't, so we'll talk about that. No economic hardship safeguards at all. Small bank loans, that's your local financial institution. They're going to have fees and high interest, no forgiveness deferment, not made for students, and no economic hardship safeguards. But there is still a reason to go get a small bank loan if you need one, or a large bank loan, which again is more similar to private loans. So we'll talk about all of them. There's pros and cons to each. So what is an aggressive loan? So today we're really focusing on how to sort of recognize and protect yourself against dangerous loans, or loans that are looking to take your money and not help you, right? So an aggressive loan can be long-term or short-term. I think generally speaking, short-term, a lot of the loans we'll look at example-wise are short-term. They often have targeted ads that prey on people who need cash in a hurry, right? So I think, one of the most unfortunate pieces of aggressive loan schemes is that they're really targeting people who are inexperienced and don't know how to identify a risky loan. So they are looking to take your money in an aggressive manner. Yeah, create people in a cycle of debt. There's some loans that are looking to sort of get you in this continual taking loans out to where your monthly payments become a substantial piece of your income. Strip assets from borrowers. So we'll talk about that. That's a specific kind of way that loans can target you, and usually result in a default or a default on the loan, which is bad, or a loss of house, and so on. So why avoid them? Well, besides all the nasty things I just said, these loans are designed to take the money, right? They're not like a government loan you get from financial aid is looking to, help you educate yourself long term, and often have lower interest rates as a result, and have protections for you. And you can actually work on how you repay them in a way that isn't necessarily looking to profit off of you. Okay, often create cyclical debt. We just talked about that. What that means, though, is that continuing borrowing leads to increased costs. So what you're going to do, when they're going to get someone in cycle of debt, what they do is they look to offer you another short-term loan to pay off the loan you currently have, right? This is often a payday scheme when you get a loan that is the equivalent of your next paycheck, and then when you get your paycheck, you pay off the loan with interest, but you can't quite afford that, so you get another payday loan. You can see how the cycle develops. Debt increases even faster. Your monthly payments become sort of an unreasonable expense on your life, and that's what they're looking to do. And actually, it's important to add, a lot of these are heavily regulated in many states. There's a substantial amount of laws to protect borrowers in Oregon, at least. We do have some protections. For a fun fact, I believe it's Tennessee is the state with some of the least protections and some of the most high risk aggressive loan schemes. So just some trivia for you. All right, so let's talk about some specific types of aggressive loans, just so you know all the nasty ways loans can target your wallet. So asset-based lending, trying to strip borrowers of their equity. So that means that they're looking to you're going to take loans out against things your sort of your net worth, right? That can be anything from specific assets like cars or homes or things that you own that have substantial value as kind of collateral. Risk-based pricing, and this is kind of a general thing that most loans do, but some specific loan schemes are looking for this. They're looking to lend money to high-risk borrowers. They're not looking to give loans to people who are super trustworthy and good debtors, because then they can't take their property and money. So just know we'll talk about this later when we look at how to identify them. But when you see those sort of things that when you see advertisements that sort of call out like, hey, you don't have to have any credit or any of these things, it should immediately be a red flag. It's like, okay, so they're looking to loan to me, even though I'm a really risky person to loan to. It's probably a bad loan. So we'll talk about that. Loan flipping is common payday practice for customers. We already went over this. To pay off an existing loan, you'll get another loan, so on and so forth. And you kind of create the cyclical debt that's really damaging. All right, so there's a few more we're going to talk about, and of course there are actually a very, very diverse number of ways loans can be looking to take your money in sort of what could be illegal ways, but these are the 6 most common sort of techniques you'll see. Loan packing is hidden, and this loan packing can be a part of, these can all combine into a loan that has several different aspects to it that fit many of these categories. Loan packing is when you see hidden fees or unnecessary services hidden within the documentation of the loan. So you got to be very careful when you read it. So they're going to hit you with hidden fees. And I think a good way to sort of get a mindset of what that is, when you download a piece of software, like an installer, and you're just mindlessly clicking through it, and it has some optional piece of software that you can install if you click yes, but you don't read the fine print and you just click yes anyways, and you get the Bing search bar attached to your browser. All right, so reverse redlining is focuses on redlining laws are basically try to focus on giving minority communities in disadvantaged areas sort of advantageous financial opportunities, or advantageous is perhaps not the right word to use, but more equal loan rates, and try to protect against preying upon minority groups. But reverse redlining is where the opposite. Through these laws, they're actually in several states. I didn't see any examples in Oregon, so don't have to be as careful here. But in many states, there are reverse redlining is a loan institution will look to exploit these laws and kind of work them so that they can actually use the laws itself to ironically offer aggressive loans targeting minority communities. Okay, and then finally we have balloon payments, which is small incremental payments before one large one. So you didn't know that there's going to be this huge payment at the end of your loan repayment plan, and all of a sudden you get hit with it, and it's you default on the loan, and that's really bad. This is not necessarily aggressive if it's disclosed ahead of time and you're very confident of it. So you can play it by ear. So how do you recognize bad loans? Yeah, you just learned 6 different ways that these bad loans exist. Well, how do you know? Firstly, they're too easy to qualify for. And the unfortunate truth of loans is that they aren't easy to qualify for a lot of the time. Good, safe loans would be, they're going to check your credit. They're going to look at your history as a person taking out loans. They are going to look at your assets, and they are going to decide whether your age, your job, your employment, all these things. And they're going to make a decision about whether or not they can offer you a loan. So if it's too easy to qualify, if it just seems like a breeze, it's probably too good to be true. And we'll look at some examples later. Vague costs, that's a good one too. Is if we talked about that, right? That those hidden fees and services. When the word of the loan is vague, I think people often have this sort of, or I know I do too. When I'm reading some financial documentation, you look at it and you go, well, I don't understand it, but I don't understand financial jargon either. So, I'm just going to assume it's not looking to take advantage of me. It's like, well, you actually have to read the fine print and make sure you know what you're agreeing to. And if you can't understand it, that's probably a good sign that you shouldn't take the loan, or you should at least, vet it with a family member or a friend, or even another financial institution. See if it's something that's safe for you to use. So definitely get a second opinion, right? Excessive penalties and fees, right? I mean, know what the industry standard is in your area. Do some research, and just know what fees and penalties look like. And every area is different, and every loan is different. So just you have to do some shopping around. You can't take the first thing you see. Yeah, interest rates far outside the industry standard. Don't, your loan should, make sure you shop around. I guess it's the same thing I just said, but make sure you compare interest rates and loans. Don't take the first thing you see just because you qualify for it. No credit checks. We talked about that, but that's like, I think when I was looking around at examples of loan scamming, all of them say no credit check or bankruptcy okay. It's like, well, why aren't you checking my credit? You probably should be to know whether or not I'm going to be a reliable debtor. So you need to take a look at my credit and find out what that looks like. And we'll talk about credit later on too. We'll have a brief overview. Lenders, and this is a big one, lender is listed on the FTC scam alerts or CFPB complaints database. And now these 2 links, you can also just look up like FTC scam alerts, like FTC loan fraud, if you don't want to copy over the link. That is where you're going to find a lot of financial scams, loans included. So take a look on these websites, and every time you're about to get a loan or you're considering one, make sure you vet it against these lists, this database that has cataloged dangerous loans, And also, I should add, if you do happen to fall victim to a bad loan, and you think that you've been sort of taken advantage of, make sure you do report it to the FTC and CFPB, and you can help defend other people too. Great. So let's go over an example. So remember, actually I want to cover again, to recognize a bad loan. It's too easy to qualify for. It's got vague wording. Or it might be on the FTC database, and it's got interests or fees way outside of the industry standard. Okay, so example, Jake is driving to class on campus and blows 2 tires. He does not have the money on hand to repair them out of pocket, but he really needs to repair the tires. What kind of loan should he look for? Should he A, utilize additional student loans, B, get a short-term loan from a private loan company, C, consult his financial institution, explore options for a private loan, D, put it on his credit card, even though he is sure he won't be able to pay it off in full? So the answer is actually, there are 2 ideas. Utilize additional student loans is an option if you have. So this is, we talk about this a lot with students sometimes, but let's say you have an expense that you need to pay for, and you have student loans that you have student loan money that's been given to you. So what you have to do, if you want to go down the path of if you're thinking about using student loans, I'd say be very careful, right? You want to make sure you're not using money that you need for school or housing or other basic necessities. So make sure when you're doing this, you're going to make a budget, right? If you want to go down the student loan path, make a budget. And we have plenty of workshops on budgeting online. We even have like a short take on it too. So if you want to learn the basics of budgeting, go watch one of the loan work or the budgeting workshops, and you'll get that squared away. You'll learn a bit about that. So, but yeah, make sure you plan out a budget. And if you budget out all the student loan money that you've been given, and you feel like you're not going to be shorting yourself for other needs, then you can use that student loan money to make an emergency purchase. But make sure that you don't want to do it in place of school or other needs. Okay, should you get a short-term loan from a private loan company? Generally speaking, no. That should not be the first thing you go to. If you really have to after everything else, then you could consider it and be very careful and go shopping around for loans. But that is not one of the first things you should turn to. Consult his financial institution and explore options for a private loan. C is absolutely a good choice too. You want to consult your local financial institution, one that you're already a part of generally, and if not, one that you could be a part of, and explore options for a private loan specifically for paying off what you need. You don't want to get an excessively large loan, and you want to make sure that it's going through a safe, vetted, reliable financial institution. Right. So it's the one you're already banked at. Or you can shop around, look at other financial institutions in the area and see which one has the best rates for you and get a loan from them. Put it on his credit card, even though he's sure won't be able to pay it off in full. Obviously, that's something to avoid, right? Don't put anything on your credit card if you're confident you won't be able to pay for it and you're going to miss the payment, because then you just get into that cyclical debt, right? Credit card interest rates are anywhere from 10 to 20%, depending on your credit, and that's a lot worse than a lot of loans. So. And that's definitely not the way to go. All right, example 2. Audrey filled out the FAFSA, but did not qualify for federal aid. However, she does not have enough money to pay for housing costs while attending college. She shops around for several loans. Eventually, she finds an online loan agency offering student housing money with no co-signer needed. Better yet, they're not requiring a credit check to apply. Should Audrey take the loan? Why or why not? So, we just went over this. She probably shouldn't take the loan. So the big red flag immediately is no credit check to apply. Well, if you don't need credit, then how else would they verify I am a reliable, I'm going to be reliable to pay off the loan, right? And the other option would be like, okay, I have a co-signer. That's someone who signs on and takes the responsibility of paying off the loan with you. They're the ones who are going to, if you run into financial pain or financial situation, they're the one who is going to, sort of take the responsibility of that. And a good example of that is when you move out of the dorms for the first time and you move into an apartment. Often students do not have the financial ability to pay for the rent that they're going to be moving into, so one of their parents co-signs the lease with them. Right. So we know that there's no credit check, but there's also no co-signer needed. Right. So that's 2 big red flags. There's no credit check. Well, that's okay. Maybe if it's a student loan, because not all students have a credit score. And there could be some student loans that are looking to actually help students from a private agency. At the same time, it says no co-signer. So how do they have any confidence that I'll pay back the loan? They don't. And that's okay with them. They're looking to get Audrey into this cyclical debt. So Audrey shouldn't take the loan. All right, what do dangerous loan ads look like? So I have 5 loans up here, some more egregious than the last. So from left to right, on the top left here, we have payday too far away and need cash now. We can help. So quick, easy, and hassle-free, no obligation. Loans, generally speaking, are not going to be quick, easy, and hassle-free. Unfortunately, they're going to be somewhat of a hassle sometimes. no credit check, prior bankruptcy, okay, new job, okay. So basically, they're saying that you can have no evidence of reliability, just a completely new employment, and have already defaulted on loans previously. We should know that that generally means they're looking to take advantage of you. I would not trust that loan agency, because why are they loaning money to me if they know I won't be able to pay it back? Well, because they're looking to ultimately profit off me defaulting on a loan, having to get more loans from them, so on and so forth. You see payday, right? It's kind of the buzzword we're looking for here. So this one in the middle here follows the same approval rate. One of the things that I thought was interesting about this is it says immediate approval. Loan agencies and public and private institutions will not immediately approve you for anything, right? They're going to take a long time looking over your history and make sure they can trust you. So it's never going to be an immediate thing. If it is, then that's kind of a red flag. You know, think of the FAFSA, right? That's definitely not immediate. It takes a while for it to get back to you after they look at your financial ability and then make a decision about what you're offered. Instant loan for homeowners, right? So what I saw over here in this ad is that we offered a $5,000 same day cash, no qualifying. So bad or no credit, okay, right? But we do see homeowners, right? So it's likely going to be some sort of asset-based loan where they're looking to kind of use your house as collateral, or other assets, your car even, and they're looking to strip those assets from you. You know, they're giving you $5,000 against your house and or other things like that. So in the end, if you can't pay it off, they will, you know, just take some piece of your property that you know you've approved in the contract. Okay, so bottom left, you know, this again follows all the same red flags, but it says 256-bit secure app. So that basically means nothing, right? Saying something is secure, it's kind of that is sort of looking to trick people who think that they hear some sort of like number associated with security and app to be like, okay, this is like a reputable company that's going to like has my security in mind. Really what that means is nothing, right? Almost every digital electronic transfer from a financial institution is going to be secured just through the nature of it. So don't let that fool you or make you think that they, you know, they're more trustworthy. It's the same. This one's really funny. I love that. This one has 100% approval for loans, which I think is very, you know, think about everyone you know. Would you approve everyone you know that you've ever met for a loan, regardless of their past? No, you probably wouldn't. If any of your friends came to you and asked you to borrow money, would you give your money to any of your friends who asked? I doubt it. So why would you have a company that gives out 100% approval for every loan they see? Well, because they're looking to take advantage of people who are in a tough spot and really need money. They need that payday loan, right? They're looking to take that money from you. So don't let it, you know, not everyone gets approved for a loan. Not everyone gets approved for a credit card. You have to have good credit. And if you want to build credit, you know, if you're here because you have bad credit or not bad credit, but you're looking to build credit even, or, you know, any of the above, and because you need a loan or you're thinking about in the future, you might need a loan and you're considering one of these, you know, dangerous loans instead, I would really urge you to go look at our other presentations about credit. It's really, we focused a lot on how to start building credit, and it can really help you. You know, I actually followed a lot of the information and it, you know, I've used that to sort of help develop credit history. And then finally, okay, cash, signed to get a loan in minutes. Of course, loan in minutes. How does that even make sense? But but you know, I actually didn't look into cash or okay cash immediately, but I do want to say there are a lot of apps on the App Store now that have this sort of like sleek design to them and kind of get you thinking like, okay, it's a modern feel. It's not going to be an aggressive loan scheme, but you know, they are, you know, this is targeting more of the younger generation who's kind of like finds comfort in this like minimalist design. So even, you look over this payday loans, you're like, well, I wouldn't fall for that because that looks very antiquated. But this OK Cash or O Cash, this isn't, right? It looks sort of hip and more similar to things we see on the App Store. So don't let that fool you. So you're like, all right, well, what can I do instead? Because I need money and I don't necessarily know. I was thinking about one of those loans and now I'm not. So what can I do? Well, step one, become banked. And what that means is you establish a history with a financial institution. And that could be a credit union. That could be a big bank, like a big like federal bank sort of thing, I should say national branched bank. So, just basically establish history with this financial institution, get a credit card, that you can use to start making, you get that credit card and you start only putting small payments on it every month that you can pay off in full every month. Like let's say you use your credit card only to pay for gas, right? And your car. That's actually my tactic, right? Is I have a credit card and I use it for gas and online purchases sometimes. So yeah, there we go. And again, you should go watch the presentation about that if you want more information about credit, because we really break down credit scores and all that. We also you can read about it online, and I really urge you to if you want to learn more about credit. Financial institution, right? I just talked about that, and finally started budget. I've said this again, and I'll say it again. Budgets are definitely the first step to financial wellness, and that is kind of I wouldn't say it's our mission statement is to financially empower students, but the budget is almost like our go-to, right? So starting a budget. And again, we have whole presentations on that too. So do I have a credit score? Where? Just a brief overview. If you're like, okay, I keep hearing the word credit, do I have a credit score? Well, here's how this works. If you have a credit card, you have a credit score. You do, and you have credit history. Other contributing factors are bank loans, mortgage, things like that. Public student loans do not establish your credit score, generally speaking. So if you want to check your credit score, because you're like, oh, I have a credit card, I had no idea that I have a credit score. Well, you can get one free credit report each year from each of the 3 consumer credit reporting bureaus. That's Experian, Equifax or Equifax, and TransUnion. And you can actually go to their website and get them, or you can go to annualcreditreport.com and request them from them. They have to give you one free credit report every year. So if you want to look at a full breakdown of your credit history, go there. If you want to get a credit score, like from your FICO score, which is basically like a numerical summary of your credit history, you can, some institutions let you check that for free. Because the credit report bureaus won't actually give you a credit score. But you can also use things like Credit Karma, which give you like a rough estimate of your FICO score that's generally pretty accurate. So you've listened to all this and you're like, well, thanks, but I still need a loan. What do I do? Well, private student loans can work, but it's important to do your research. So if you still need that loan, that's okay. But what you got to do is you got to shop around, right? You cannot take the first thing you see, and you can't take the thing that's easiest to qualify for. That is a good way to get yourself in a bad spot with a loan. And loans are dangerous, right? That's why we're doing this. So do your research. Look for the best APR, verify your loan agency at the FTC website discussed earlier, and remember the examples of dangerous loans. And make sure when you're reading through the loan documentation, look for those hidden fees, those balloon payments. Look for any sort of things that's going to pack extra cost into your loan. Just make sure you really keep that in mind. And also, I didn't put this up here, but I would say get a second opinion. 100%. If you're going to do a private loan, especially not through like a established financial institution, make sure you get a second opinion on the loan documentation itself. It's really important. Okay, summary. So we learned what aggressive loans are today. Loans that are looking to take advantage of people who are inexperienced with loans and in situations where they need money. We learned how to recognize them with some examples, and remember the big one: if they're not checking my credit, if they're not checking my history as someone who takes out loans, then it's probably a bad sign. And then We learned what loans do to these to borrowers who get them and why they should generally be avoided. All right, that's it for the workshop. Thank you guys so much for attending. Real quick, I'm going to go over just some things about the Financial Wellness Center. So we have peer financial coaching. If you have any questions about loan awareness, schedule an appointment with us. Talk one-on-one with a peer financial coach. We do earning, spending, borrowing, protecting, saving, and investment, and more. So just feel free to schedule us at our website. Appointments are available through that date is wrong, but they're through the end of spring term. So sorry. And starting again winter term. Well, winter term's come and gone. So, but yeah, they're available all through spring term if you want to go sign up for one. Okay, next up, May 18th at 5 p.m. car buying workshop. We're going to discuss, good strategies for buying a car, sort of how to do your research, how to know what you want. So there you go, and how to afford it. Of course, the most important part for us. Be on the lookout for the upcoming events. Federal loan repayment, May 25th at 4 p.m. I know I'll be there. I definitely have been thinking about that a lot recently. All right, and that's it. So if you guys want to stay connected with us, our website, which I've been saying repeatedly, is financialwellness.uoregon.edu. You can email us at financialwellness@uoregon.edu. And if you want to follow us on Twitter or Instagram, it's just FinWellness. And you can also check out our YouTube for more for these workshops or our Facebook. So thank you guys so much for attending.